Yeah, I do go back and look at those from time to time. So we'll have those up there and continue this process. And I think I've got the workflow down now where there's not too much delay in getting it up there sooner, assuming I remember to publish it after I load it. But hopefully that's going to be useful to some of you. Okay. So what happens with Chapter 6? Chapter 6 really is a accounting focused chapter again as I looked at it. It once again is talking about how to generate financial reports and how to generate them in a manner that they are useful for internal purposes. And so we're going to see that we're going to want to set up our financial statements where we're showing our selling price, we're taking off our variable costs, and we're showing our contribution margin. Okay? Now, what we're going to do when we use this variable cost format, this contribution margin format, is we're going to actually expense all of our fixed costs for the period. We're going to expense all of our fixed costs. Now, this is different than what we learned when we were going through and understanding that we have what? We have our raw materials, we have our direct labor, we have our manufacturing overhead, and we have both our variable and our fixed manufacturing overhead. Example of fixed manufacturing overhead? Huh? Rent is probably a fixed manufacturing overhead. Our sales, not our sales tax, our property taxes is probably a fixed manufacturing overhead, right? How about variable manufacturing overhead? Indirect labor is a good example, or at least a portion of that indirect labor would be could be considered variable. The variable portion of our utility bill, sort of the mixed cost that we talked about, the variable portion. Okay, and what we're going to do with variables costing is when we what we studied is we took what? We took our direct labor, our direct material, and we took all of our manufacturing overhead and included that in our work in progress, from work in progress to finished goods, from finished goods to cost of goods sold. So it didn't hit the income statement until we actually sold those items, right? What we're going to do under this alternative method called variables costing is we are only going to include in our inventory the variable portion of our manufacturing overhead. All of our fixed costs, our selling and administrative fixed cost, as well as our manufacturing fixed costs, will be expensed for the period. So what we're going to see is we'll get a different answer for our operating income if we're using the GAAP methods that we were studying before, which, by the way, we're going to call absorption costing, versus what? Versus variable costing, which is the method that I just described to you. Now, again, guys, this is very much an accountant's game, is this variables versus absorption. Typically, if I'm teaching this class to a general business class, I don't get into variables versus absorption because it is a very accountant-focused type of an analysis. I teach it when I teach cost accounting for accounting majors. That's when I really make them understand that. But here at Ohlone, we try to be a little more in depth into some of the things that we get into in some of the classes. So we're going to have to make you understand in this class variables versus absorption. I don't have control over that.
Do they have cost accounting?
At Ohlone? No. Ohlone accounting classes that I'm aware of, we have this one. We have Introduction to Financial. We have a tax class. That's all I know of here. Okay, so some people are trying to influence them to add additional classes to the accounting curriculum. Some people are, but I don't know that they're listening to that. We'll probably stay with, we'll probably stay with the classes we have. If you want cost, typically you're going to have to go to, a university, although I think there are some community colleges that teach it. I think Mission College has a cost accounting class. I think College of San Mateo, Foothill College, some of those others have that. but for some reason we don't have it here. But that, if I was teaching a cost accounting class, absolutely, I would expect you to know variables versus absorption because really my main reason why I would teach it is it's asked on the CPA exam. CPA exam expects people to understand that, and so I can't be teaching an accounting class to accounting majors and not cover something they very well could potentially be on the CPA exam. Okay, but having said all that, that's just giving you a little perspective. That's not to say that this is not important, and it's clearly important because I was just looking at your final exam. You're going to have about 6, 7 questions on the final exam to get into this stuff. So out of the I think 50 questions on your multiple choice multiple choice questions on your exam, so you got to know it, right? It's going to constitute about a fifth of your exam. Okay, so we'll go through and we'll understand this, and we should be in good shape, and then I'm going to give you plenty of practice with it. Okay, so we have these two methods. We have absorption versus variables costing, and let's just take a look at this nice little comparison of the two. Okay, and let's take a look at absorption because that's what we were studying in our earlier chapters. Okay, when we look at absorption, our product costs include what? Include direct materials, right? And we've known that for a long time. I guess I'm going to have to change the color up on this to get any bang for the buck here, right? Okay. And then what? Then we have our direct labor. Is that part of our product cost? Okay. We had our manufacturing overhead. And look, guys, we didn't call them out as variable versus fixed before. We just said manufacturing overhead was part of our product cost, and that's still the case, right? Yes, sir. In the slides for chapter 6. Huh? Yes, I did. I just published them. I didn't publish them before. Okay, well, let's just take a picture of it then. I don't know what to tell you. That slide should be in there. Let me see. I should have just gone to the bar and watched the football game. I sat there all through the game trying to get this thing together for today, and this is not doing me any good at all. Let's see. The Raiders, of course. Let me discard this. Let's see what's going on here, guys. Hang on a sec. Let me pause this as well. Resume. And from current slide. Okay, so let's go back. Let's start over on this now. And so when we're talking about our absorption costing, this is what you use for your external reporting when you prepare your financial statements. It's what we studied in our earlier chapters. And remember, our product cost included what? Direct materials, direct labor, and then manufacturing overhead. We did what? We included all of it, whether it was fixed or variable, right? We didn't make any distinction, and that was all of our product cost. And when we had our product cost first went to what? First went to to work in progress, and then from work in progress to finished goods, and then from finished goods to cost of goods sold, right? Cost of goods sold. Okay, and so they really didn't hit the income statement until they were sold, right? They're on the balance sheet up here, and they were on the income statement only after they went to our cost of goods sold, right? Our product cost, okay? Our what? Our selling and administrative expenses were treated as a period cost, and again, we didn't call them out as variable versus fixed, but they were a period cost, meaning that each period they went straight to what? Straight to the income statement, and we didn't include them in inventory at any point in time, right? Okay. Now, when we get to variables costing, we're still going to treat our direct material and our direct labor as product cost because they are variable cost. Our variable manufacturing is going to be treated as a product cost because it is variable. So under variables costing, we only treat our variable cost as a product cost. So only our variable costs do what? Go through this process of what? Work in progress to finished goods, and they don't hit the income statement until the items are sold. Under variables costing, we still treat our selling and administrative as period costs, so they're going to go straight to the income statement just like they do under absorption, like we were studying before. The key difference between the two methods that we're going to talk about here today is that our variable manufacturing costs are treated as a period cost under, and why am I highlighting then the selling and administrative? Our variable, our fixed manufacturing overhead are going to be treated as a period cost. They're going to be expensed. So the only difference between the two is what? Our fixed overhead costs do what? They go straight to the income statement, don't they? That's the only difference between those two methods. Are what? Are direct labor, direct material, product cost under both, right? Variable manufacturing, product cost under both methods, right? Going to go through the process of going through to the work in progress, to the finished goods, to the cost of goods sold. Are selling and administrative, both fixed and variable, straight to the income statement, right? No resting on the balance sheet. Whereas our what? Our fixed manufacturing, if we're talking about absorption, part of our product cost, right? If we're talking about variables, it goes what? Straight to the income statement, is expensed. Okay. Variables is only method is only available for internal reporting. This is not something you use for external reporting. We only use it for our internal reporting purposes because we're going to see that it is going to facilitate the preparation of our contribution format financial statements, in which we're going to take sales minus all variable costs, going to give us what? Give us our, and we call that contribution margin, and then we're going to take out all of our fixed expenses in the calculation of our operating income. We use that for internal purposes only because it then facilitates some of the things that we talked about, our cost volume profit analysis, our what, our break-even analysis, etc., right? Okay, good. So that's the key difference between the two methods. And so let's just go ahead and take a look at a couple definitional type questions. Everybody's favorite is the definitional ones, right? Okay, so let's go ahead and let's take a look at these. Okay, and we say which of the following costs at a manufacturing company would be treated as a product cost under both absorption and variable. Okay, so variable manufacturing, yes, right? That was a product cost under both of them, right? Okay, whereas what? Variable selling and administrative, no, that is not a product cost under either of them. Under each absorption and variable, under both absorption and variables, it is treated as what? As a period cost, isn't it? Okay, good. Now you take a look at this next question, and under absorption costing, production costs include, or product costs include, variable manufacturing. Do we pick up the variable manufacturing under absorption? Yes, we do. We pick up the variable manufacturing. Do we pick up the fixed manufacturing as a product cost? So this is a yes, right? Now, if I could ask you the same question, and if I just change the word absorption to variables, this would be a yes, no, wouldn't it? Under variables? Okay, good. So that just gives you sense as to some of the theoretical underpinnings. And what we're going to do is we're going to sit here and literally walk through a couple of examples to see how the outcome for our operating income will differ between absorptions versus variables. And the only difference between is going to be what? How we treat the fixed manufacturing overhead. How we treat those is going to be the only difference between the two methods. Okay, so let's just go ahead And let's take a look at this Harvey Company. And Harvey Company produces 25,000 units annually. So each year they produce 25,000. We don't know exactly how many they're going to sell, but we know that they produce what? 25,000 each period. Okay, now they give us our variable cost per unit, which is going to be our obviously direct materials, our direct labor, and our variable manufacturing overhead. And then they give us the variable selling and administrative. So we've grouped our variable cost together. Then we group our fixed, including both our fixed manufacturing overhead and what? Our fixed selling and administrative. So all they've done here is grouped our costs into whether they are fixed or variable. Okay, and I just want to go back to the pen here. I think it's going to work a little better for some of these upcoming things. Okay, good. So let's just come over and let's take a look then. And let's take a look at our product cost under the two methods. Now, if we are using absorption, we pick up all of our variable costs, our direct materials, our direct labor, and our variable manufacturing overhead. They're telling us the total of those are $10 per unit. And then we have to pick up our fixed manufacturing, don't we? So we go ahead and we pick up the fixed manufacturing, $150,000 of fixed manufacturing overhead divided by the 25,000 units gives us $6 per. The only difference between the two is between variables and absorption is what? How we treat those fixed manufacturing overhead. They are not part of my product cost under variables, right? Only the variable costs are. Okay. How about my variable selling and administrative? Are they in there? My variable selling and administrative are not part of this product cost calculation because selling and administrative costs, neither fixed nor variable, are my product costs, right? So it's only what? It's my direct materials, direct labor, and the variable portion of my manufacturing overhead. My product costs are still those three stooges minus the fixed, right? Okay, for variables. Okay, good. Now we come over and take a look at this question. Okay, and all this question was asking me to do here was calculate my let's see if I can put my little cheat sheet up here like this. Probably not. Okay, all this problem was asking me to do was sit here and come up with my what? Unit cost for absorption costing. So I know I have to pick up what? Direct materials, direct labor, variable manufacturing overhead. So I get on my variable, but I also have to pick up what? Fixed manufacturing overhead, right? Okay, so let's see if I can do that. And I know the answer's down here, but let's just write it together, okay, so we can kind of see how we go through this as a problem. So do we have to pick up this 29 for the materials? Pick up that 29 for the materials. Got that. How about the 49 for the labor? Got to pick up that. How about the variable manufacturing overhead? Good. Got to pick that up. How about the variable selling and administrative? Nope. That's going to be expense. That's a period cost, right? It's not a product cost. How about my fixed manufacturing overhead? Got to pick that up. Now, they give me the total, don't they? So I have to figure that on a per unit basis. So I take that 94,900 and I got to divide it by, and this is one of those annoying things that you're going to have to remember, guys, that if we're talking about our product costs, it's the units what? Produced. Product cost. See how you almost have to like hypnotize yourself into it? Okay, so product produced. You use the number produced, don't you? Okay, because we're going to spread that out over the number of units that were produced. So we take that 94,900 and you divide that by 7,300 units produced. And when you do, you come to what? This $13 per unit. Okay, and you add all those up, and I'm just, sort of doing the same thing they did down here. And that's $96 per unit, isn't it? Okay? Okay, now, with all that, let's go ahead and let's mess around with this question a little bit. Okay? So let's say that we sell, let's say the selling price for this thing, I'm just making this up, is $127 per unit. Am I making this up or did they say this somewhere? I made that up, right? So it's $127 per unit. So I'm going to go ahead and I'm going to prepare my absorption costing, my GAAP income statement using all of this information now, right? Okay, so I go ahead and I have a sale. I have sales of what? 127 times how many units? Times the 72, good, that got sold. That gives me what? 914,900. $914,900, right? Okay. Now I need to come up with what? Cost of goods sold, don't I? Is that how you prepare an income statement? Sales minus cost of goods sold. And I've got what? I've got $96 per unit times how many units sold? Times 7,200. 691,600. 200. Okay, good. So my sales minus my cost of goods sold should be giving me my gross profit, shouldn't it? $914,400. $914,400, you say? Minus what? 691,200. That number's right. And that gives me what? Gross profit of 223,000 what? 200? Okay. Okay, good. So we go ahead and we get that number. And then what? Then we have to take our selling and administrative, don't we? And when we take out our selling and administrative, let's see, we've got what? Both variable, which is $4 per unit, times how many units? Times the units sold, good, 7,200. So that 4 times 7,200 is going to be what? 28,800. Okay, good. And then we've got to do what? Pick up our fixed. And our fixed is how much? Oops, 79,200. Okay, so we got the variable. We got the fixed. And the fixed they just give us to us in total, which is 79,200. 79,200. Okay, and so you go ahead and you take those off, and that means that my operating income is how much? 115,000 what? 200? Okay, good. So we've got 115,200 that we're coming up with here. And So now we're going to go ahead and see what happens if we do this. Before we do that, though, let's just follow through and understand what happened here. So we had our, and I'm just going to start at work in progress. And my work in progress would have been what? Would have been $96 times how many units? Times 7,300 units. So 96 times 7,300 units would have been what? I'm having you guys help me. 700,800? Like that? Okay, good. And then what? Guys, I got to tell you that this is not the time to tune out. I mean, this is everything right here. If you get this, you get it. If you tune out and you take a trip into, relaxation land, you're never going to get it. I promise you. You'll keep sitting there saying, I don't understand absorption. It is really confusing. If you follow this and you understand this, you got this. If you tune out, you start talking to somebody next to you about why they're late, you're going to have a problem. Okay, so work in progress got debited, and then I'm going to assume that they finished all of this stuff. So if they finished all of this stuff, what happens? 700,800, right? And we're going to put that to what? Put that into finished goods. Good. Okay. All right, good. So when we get to our finished goods now, we are going to debit that for 700,800. Okay. And now I want to figure out how much my cost of goods sold was. Cost of goods sold should have been what? 691,200, you say? Okay. 691,200. Which means my cost of goods sold is 691,200. Which means that I have how much left? 9,600, and it's spilling over into my credit side of my cost of goods sold. I don't want that to be a credit to cost of goods sold. It's a what? It's a balance that's left. Keep talking to your friend. Go ahead, keep doing it. And I'm telling you, you're not going to understand what we're doing here with this variables costing versus absorption costing. I promise you. And so we're ending up with what here? 9,600. Okay. Now we take this 9,600, and when you have this 9,600, how many units do we produce? What was the difference between what we produced and what we sold? There's 100 units in ending inventory times what? Times $96 per unit. There's that $9,600, right? With me so far? Okay. Now, what I want to do is I'm going to go ahead and continue to play around with this question. And now I'm going to go ahead and I'm going to do variables with this same question. I know the question was asking for what? Was asking for absorption, but I'm going to do it with variables. Okay, so I'm going to go ahead and I'm going to first get my variables product cost. And I'm going to erase that line because it's kind of in my way here. I don't need it. Okay, so let's do variables. So I'll just write variables up here. And I first want to get the product cost. So should I pick up the 29? Pick up that 29. That's what? Direct materials? Direct materials 29. How about direct labor? Direct labor, got to get that. That's 49. How about variable manufacturing overhead? Got to pick that up. So manufacturing overhead, the variable manufacturing overhead. How much is that? $5. Okay. Should I pick up anything else for my product costs? So if I'm sitting here and I'm doing my variable, I should get what, 83? $83 per unit, right? Okay. So now I'm going to go ahead and I'm kind of getting tight on room here. Do they let me write over here? Let's see. Sales price, let's try it. Okay, good. I got a little more room than I thought. Sales price is, again, that's not going to change. That's what, 914,400, somebody said? Okay, now what I'm going to do is do a contribution format financial statement so that I can go ahead and come up with my variable cost per unit. Okay, so I know that it's what? It's $83 times how many units? Times the 72. So that's giving me what for my variable product cost? Huh? 597,600. Okay, so I got that 597,600. Good. That's 597,600. But now I'm doing a contribution format financial statement, so I better take off my variable costs, right? My variable selling and administrative costs. So I can come up with my contribution margin, sales price minus my variable cost. So my variable is going to be what? 7,200 times 4 now. I don't know why I had to write 7,200 again, because it was right there. But 7,200 times 4 gives me what for my variable selling and administrative? 28, how much? 28,800. Okay, oops. I made a mistake. It's 7,300 times what? It's 7,300 because it's what? It's the units sold because these are selling costs. Units sold, selling, right? Units sold, selling. Yes, sir. $4 is my variable selling and administrative expenses, which is what I'm taking off right here. Okay. And so times 4 is going to be what? 29,200. Okay, good. So I got my 29,200 that I'm going to take off. $29,200. Huh? 29,200. Okay, so that gives me now, have I taken out my variable costs? Have I taken out my variable costs? Have I taken my variable costs? Got my direct material, got my direct labor, those are variable, got my what? Variable manufacturing overhead, that was the 5 that was included in the calculation down here, right, to get my product, where is it? In my calculation right here to get my variable product cost, so I got that one, and I've got my what? I've got my variable selling and administrative, don't I? I changed it to 7,300. I wrote 72 and then I said I should have put 73. So I've got what? I've got my selling price, my sales price, my what? My variable product cost, my variable selling and administrative, right? That's all I've done here. But I have all my variable costs, don't I? All I'm asking is, do I have all my variable costs captured here? Direct material, direct labor, variable manufacturing overhead. That's how I got the 83. And then I multiplied that times 7,200 because those are the units I produce for my product cost, right? Then I took what? Then I took the 7,300 units that I produced times 4, 29,200. We're in agreement on that number? Okay. So have I taken off all my variable costs? Have I captured all my variable costs? Okay, good. So the units sold is 7,200. Yeah, I should have used 7,300 for the units produced. No, huh? No, it's not units produced. Because I'm taking off, I'm calculating income here, guys. I'm calculating income. I'm not using the units produced because those aren't sold. Okay? Those units are not sold, so I'm not using units produced. I'm taking sales price. I'm trying to come up with operating income using absorption. Sales was what? Was 7,200 units times what? Times $127. Thank you. Was what? 914,400. Sales minus what? Minus my costs are going to give me operating income, right? So I pick up what? I pick up that, what was that variable cost per unit? When I picked up on my variable cost, it was what? $83 times the units I sold. I sold how many? 7,200. That's going to give me 597,600. 597,600. Just taking my variable cost off here, but it's only for the ones I sold. The ones that I didn't sell are not sold, so I'm not going to take the cost of those items off in calculating my operating income, right? Because they're not sold. Okay, but then what? For selling cost, then I have to go ahead and do what? Pick up that $4 times how many units sold? 7,300 units sold, so my variable selling it 7,300 units. I have to pick it up times the 7,300 units that I produced because I'm expensing all of those, right? So since I'm going to expense all of that, it's $4 per everything because I'm trying to expense all my selling and administrative costs. So it's 7,300 gives me what? 29,200? Okay, good. Then what? Then what we've said, that gives me my what? Have I taken all my variable cost off now? Yes. That gives me my contribution margin. So I take 914 minus what? Minus my product cost, minus my selling cost of variable cost. That gives me contribution margin of what? 288,100? Huh? Okay. 287,600. Okay. For my contribution margin, and then I'm going to go ahead and take off my fixed cost. Fixed costs are what? My fixed manufacturing overhead. fixed manufacturing overhead is this 94,900. And then I have my fixed what? Fixed selling. And the fixed selling are going to be what? Okay, good. And so when I go ahead and I subtract off my fixed costs, I get what now? 113,500. Okay, good. So that gives me a difference here. What did I get for my oh, I forgot to keep going it. No, I got what? 115,200 versus what? 13,500. So 113,500 versus what I got for absorption was what? 115,200 gives me a difference of what? 1,700. Okay. So that's not working out right. Why was it different when I did it this morning? Hang on a second, guys. Something's not right. $83 times the 72 units. 597,600, right? 597,600. And 914,400 minus 597,600, 316,800 minus, where'd we get the 29,200 was the $4 times units sold, right? I mean units produced, yes. 4 times 7,300, 29,200. Okay. Huh. Well, I'm losing the battle here on this one. So I don't understand what happened, because the difference should be the items that are in ending inventory under under absorption, the amount under absorption that wouldn't be there under variables. And I'm not sure why I'm getting a different number here. It worked this morning. $509. Because if you look at it, I can't even find my pen up here. When you look at it from the standpoint of the work in progress, let's just do the work in progress. I'm not going to do it here because this is starting to turn into somewhat of a problem. But let's look at, I'm going to just pause this for a second. Let's just look at the work in progress. we look at work in progress here, we have what? We have our product cost, which is going to be 83. What was it? $83 per unit was our variable cost? Right? $83 per unit on our variable cost times, and we produce what, 7,300 units? Okay. So 8,300 times the 7,300 units is 605,900? Okay, good. And that's going to come out of work in progress and go into finished goods. And then coming out of finished goods and going into cost of goods sold is going to be this $83 per unit times how many units do they sell? 7,200? Times the 7,200 units they sold, that should be 597,600, right? Which is what my cost of goods sold is. 597,600. That leaves me a balance of what in my finished goods? $8,300. Okay, so I have this $8,300 sitting there in my finished goods, and when I did this same thing, now this is variables, and when I did the same thing using absorption, I had what? Work in progress now was calculated, and now we included our fixed manufacturing overhead. So was that $96? $96 per unit. And we're going to get what? 96 times 7,200 is, 7,300 the units produced. 700,800. We're going to debit our work in progress, what? 7,800. We're just going to assume we finished all those. So we're going to debit the finished goods for 700,800. We're going to credit the finished goods for what we actually sold. So into our cost of goods sold now is going to be what? $96 per unit times what? Times 7,200 gives me what? 691,200. Okay, so if I have 691,200, and that goes to my cost of goods sold, that leaves me a balance here of 9,600. Now, if you look at the difference between the inventory amounts, 9,600 versus 83, that gives me a difference of what? 1,300. And that difference of 1,300 is what? Is the fixed cost per unit of $13 per unit times what? Times the 100 units that I haven't sold yet. That's still sitting what? In my ending inventory under what? Under my absorption, which I have expensed already under what? Under variables, right? Okay. So with these numbers now, let me try to figure out why it's not working when we do the income statement, because the operating income should only be different by those 1,300 units. So something went wrong in these calculations. But let's go ahead and let's do my sales. And my sales is what? Going to be 7,200 times what? Times 127 gives me 914. What? 914, 400. Okay. And then it's the 7,200 units that I sold times the cost of goods sold. We're doing absorption first. So that's going to be what? $96 times the 7,200 units I sold. That's 91,200. Good. That gives me a gross profit of $223,000 what? 200. Okay. Okay, good. So I get that number, and then I want to take off my selling and admin, and I need to take it all off. I need to take all of my selling and administrative expenses for the period I expense those, right? Okay, so I need to do what? I need to pick up, obviously, let's do the fixed first. That's easy. The fixed is what? 79,200. And the variable, I don't know, it seems that the variable should be by the number of units I sold here. I mean, the number of units selling administrative, oh, I see. It's the number of units, what, that I sold. I see what I did wrong. So it's what? 7,200 units times what? Times the $4? 28,800? Okay, I see what I did wrong. Okay, and when you come up, because it's the number that I sold, not the number that I produced. It's the number that I sold. That's what I did wrong. So now I get what? I take off my fixed, I take off my variable, and that gives me what for my operating income? 115,200. Operating income is 115,200. Okay, well that's the same. Okay. All right, good. Then what? Then I'm going to go ahead and I'm going to do this for what? Variables. And when I do this for variables, selling price is the same, right? 914,200. 400. And my what? My variable portion of my cost of goods sold is going to be what? We won't call it. It's a variable cost of goods sold, I guess we could call it. Is going to be my product cost of $83 per unit times the 7,200 units. It's going to give me what? 597,600. But then I have to do what? Then I have to take the variable portion of my selling and admin. Variable portion of selling and admin is, what is it, $4? Times how many units? 7,200 units sold. Gives me 28,800. So I take off all of my variable costs, my selling and administrative variable costs, my manufacturing variable costs, right? And sales price minus my variable cost gives me a contribution margin of 288,000 even. Okay. And then I take off what? And I'm going to take all of my fixed cost, right? So my fixed cost for my selling, fixed cost for selling is what? 79,200. And my fixed cost for my manufacturing. So these are all fixed costs. The fixed cost for my manufacturing is 94,900. Okay, good. And so when I take 288,000 contribution margin minus my selling, all my fixed costs, selling and manufacturing, what do I get? 113,900. Okay. And so if I have same number? No. Okay. So if I have what? If I have 115,200 is my operating income under absorption versus variable, which is what? 113,900? What's the difference? The difference is 1,300. Okay, and the 1,300 is what? That $13 per unit of fixed manufacturing overhead that what? Is still sitting on the balance sheet in finished goods under what? Under absorption that has already been expensed under variables, right? Because we expensed all of our fixed manufacturing. Okay. So the difference between the two, again, is going to be what? Your fixed manufacturing overhead times the number of units in change in inventory, right? And since our inventory went up by 100, that means that what? That means that absorption will show $1,300 more of operating income than will variables when you have a situation where your inventory levels went up and what? And you still have this $1,300 that is sitting in finished goods inventory under absorption that has already been what? Expensed or treated as a cost of goods sold under my absorption method. Okay? So I'm not sure all these calculations I did this morning were crap for some reason. Question?
So for the 8300 and 9600, can you just use the ending inventory and then?
Please don't ask me another method to do it right now. Go ahead, ask me. Go ahead, I'm sorry. Go ahead.
So
What?
can you just use the ending inventory, which is 100 times the 83 or 96 dollars?
Well, you could look at the difference in your finished goods inventory to get the difference between variables and absorption. But typically, the way they ask the question is they'll ask you, they'll basically, this is what I'm trying to lead to, and I'm not doing a very good job of it. But we would sit here, and in some of these questions, I will give you the operating income under, say, what's that over there? Variables? Variables. I'll give you the operating income under variables, and then the problem will tell you that the fixed cost per fixed manufacturing cost, fixed manufacturing overhead per unit is $13. And then the problem will tell you that inventory increased by 100 units. Well, if inventory increased by 100 units, that means that what? That means that there's 100 units more sitting in ending inventory, right? That weren't in my cost of goods sold, that were in cost of goods sold under variables. So you take that 100 units times the $13 per unit, we know already that that's what, $1,300? If you add that, doesn't that give you the absorption operating income of $115,200? Okay, so you say, can you get it looking at the inventories? And that might be an interesting way to look at it. And there might be a question like that on the exam. But some of the ones that I already have in your slide set here give you the operating income under one. And then you have to know, now if I started with absorption and asked you variables, you'd have to subtract it, right? Assuming the inventory levels went up. Assuming the inventory levels went up. Okay? And the reason that's happening is because we're sitting here, and let's just go through this whole thing again. If we're going through absorption, okay, which is what? I forgot which one's which. If we're going through, because I wrote variables here, this is absorption, right? Okay, so if I'm going through absorption and I produce my units, I produce them at what? $96 per unit. We know that's including my fixed manufacturing overhead per unit, right? That's where we got the 96? Just looking at that problem the way the textbook contemplated it, right? Okay, 96 times what? Times the 7,300 units we produce. As we produce those units, that all goes to work in process. That's my direct material, my direct labor, my manufacturing overhead, both fixed and variable, right? That all goes to work in progress. Then what? In this problem, we're assuming that they just went ahead and transfer everything to finished goods, right? So if we transfer everything to finished goods, we have this $605,000 sitting in finished goods. That includes what? All of my direct material, all of my direct labor, all of my manufacturing overhead, right? Both fixed and variable. And then the problem told us that they sold 7,300 units, 7,200 units. So I'm going to do what? I'm going to sit here and I'm going to take these, and my work in progress was I'm pointing to the wrong numbers. God, this is not the way I planned this lecture to go, trust me. God, dang it. I was pointing to the wrong numbers. 96 times 7,300 is what? 708,800. 708,800. I transfer all of that to what? To finished goods. That includes everything. It includes the variable and the fixed manufacturing overhead plus the direct labor, direct materials. That all goes over to what? Finished goods. Then we take the 96 times the 7,200. That's 691,200, right? That's a credit. That goes to cost of goods sold, 691,200. We're left with what? We're left with 9,600, right? Okay. Okay, now if we do the same thing with absorption, now it's this $83. This is less the fixed manufacturing overhead. Isn't that the only thing that's different on this whole thing? Okay, so you take the fixed manufacturing overhead, you don't include it, and so that's 605,900 that goes to work in progress. You credit the work in progress, go to finished goods, and then when we sell those items, we sell them at 83,7,200. That's the 597,600, right? That's coming out of my finished goods and going into my cost of goods sold, right? Okay, so now we're only doing what? We're only picking up the variable, right? Okay, now if you notice under the two methods here, guys, that what? That variables gives me a lower cost of goods sold, doesn't it? Variables gives me a lower cost of goods sold because we're not including or costs, costs being subtracted our variable product costs. It gives me a lower number, and the reason it gives me a lower number is because I'm not including those fixed ones, right? Okay, and so you can see that there's that lower number there, and then we go ahead and we pick up our variable selling and admin. This part, both for the what? Both for the selling administrative expenses and the fixed selling administrative expenses, they're expensed under both methods, aren't they? But notice what we do here. Now we take all of our fixed manufacturing and we subtract all of that, don't we? Okay. So even though my cost of goods sold is going to be less, my what? My subtracting of my fixed cost is going to be more by how much? By this $1,300 more, right? Because I included those costs as a fixed cost, whereas up here I'm including them up in my inventory and they're still sitting on my balance sheet. Okay? So if we look at this and we sit here and look at the difference in cost of goods sold, what's the difference in cost of goods sold between these two? Let's hope that this works out. If you take this $597,600 versus what is it under absorption? $691,200. You get a difference of what? Huh? 3,600? $93,600 is the difference between these? Okay, good. And so we have what? Higher costs right now under absorption, don't we? But then you go ahead and you take a look and you see that we took how much more in fixed cost? We took all of everything as fixed cost, didn't we? Our fixed cost total that we're subtracting additional fixed cost down here. Our product cost. These are now all of our product cost, including the ones for the ones we haven't sold yet, right? Okay, so if you subtract that off, 94,900, what's the difference? The difference is 1,300. So even though our cost of goods sold was a little higher because our fixed manufacturing overhead is up there in the cost of goods sold, isn't it? Our operating income is less, and the reason it's less because when we got down here in the contribution format financial statement, we took out all of our fixed costs, even for those 100 items we hadn't sold yet, right? Meanwhile, under absorption, we still have that $1,300 difference sitting in our finished goods, right? As opposed to having hit over and been in our cost of goods sold. And we could have compared what? We couldn't compare we just compared the cost of goods sold between the two. That won't get you there, right? Because you have to consider the increase in your fixed costs. Okay? All right, sorry about that, guys. I don't know why I had the wackiest numbers on the face of the earth on my printout here on the things I wrote down, and I can't explain where all these stupid numbers came from. Okay? Question? All right, so let's go ahead then. And let's, I was recording that the whole time? Okay, I guess that's good. Even though we don't have any visuals with it. But let's go ahead and take a look at the next question. Okay, and so the next question here wants to say the variable cost per unit, variable cost and cost per unit, which is going to include what? Obviously our direct materials, good, our direct labor, and then what? Just the variable portion of our manufacturing overhead, right? What if I were to ask you the same question using absorption? Then I'm going to add what? The fixed manufacturing overhead. So you're telling me, hey, John, just start with 111. Don't run us through that whole thing again. And pick up the fixed manufacturing overhead. Okay, which is 237 divided by what? 3,000 units produced. Good. So that gives me what? $79 more. And that's what? 190. Okay. Okay. So, you can practice with these questions that are in the homework slides, doing both, even though the question may ask for variable, you could do absorption, right? Okay, and practice with it that way. Okay, so let's go ahead now and let's just take a look at, and this example is now going to be easy for us after everything we just went through to figure out that last one. So let's just go ahead and take a look at this example. We have 20,000 units were sold at a price of $30 each. And they told us already that this Harvey company produces what, 25,000? So they produced 25,000. They sold 20,000 at $30 each. Okay, and we're going to do our operating income just like we did in those problems we just looked at under both absorption and variables, right? Okay, so let's just go ahead and let's take a look, see what they do. And if we're doing variables, remember we had the $10 per unit. That was just the variable cost. Remember we originally had looked at their costs. Let me go back to that slide since that's like about an hour ago. Oops, there it is. So remember we did, at least we're all the way back to the beginning now. There it was for variables was what? Was $10. Okay, and right here. It was $10 for variables, and it was what? $16 for absorption when we picked up the fixed manufacturing overhead. Okay, so we've got this $10 that we're doing for variables. So we sold the 20,000 units at $30. That's 600,000. We sold 20,000 variable costing using $10 per unit. We sold what? We sold 20,000 for our selling and administrative variable cost. So that gives us total variable cost of 260. That gives us a contribution margin of 340, right? Then we take out all of our fixed expenses, both the variable fixed expense, both the what? Fixed manufacturing cost and the fixed selling and administrative, right? We take all of that out. That gives me $90,000 of operating income. This is not a good time for a nap, guys. I'm telling you, you're not going to get another chance like this to understand this stuff. I'm telling you, because then we're going to move on to another chapter, and you're going to look back at this stuff, and you're going to go, I don't understand any of this. I don't understand variable versus, I don't know what I'm doing. And it's 6, 7 questions. This will cause your A to turn into a C. I promise you. Don't fall asleep. Okay? All right, good. Then you come over and we take a look at it for absorption. And notice now for absorption, we are picking up those additional, the $6, I should say, of fixed manufacturing overhead, right? So we fixed that. When we pick that up, we include it there. That gives us our gross margin, gross profit, whatever. Then what? Then we take out our selling and administrative, all of it, our variable selling and administrative, our fixed selling and administrative. We take those off, and we're showing that our operating income is what? 120 now, isn't it? Okay. What was it under variables just a second ago? It was 90,000 under variables, and under absorption it's what? It's 120. So we have a $30,000 difference. That $30,000 difference is attributable to my 5,000 units that I increased because I produced 25, I sold 20, right? So did I increase my inventory? I increased my inventory by the 5,000 units times the fixed costs that are still sitting on the balance sheet, right? Under absorption. Okay. Now, the other way that you could figure out this difference is to sit there. My cost of goods sold is 320 here, isn't it? On absorption, my cost of goods sold was sitting there at 200. Right there. Okay. And so that's a difference of 320. Oops, going the wrong way. 320 minus 200, right? That's a $120,000 difference. And that $120,000 difference is what? Is $6 times what? Times the $6 times the 20,000 units I sold, right? Because we're looking at cost of goods sold. So that's where that 120 came from, right? But then what? But then I increased my fixed expenses by what? So even though my cost of goods sold was more under absorption, my fixed expenses are what? They are 100 under absorption versus what? Versus 150 over here. Okay, because I picked up what? I picked up 120 versus what? Versus 150 of fixed expenses. Okay, I've got 120 more in my cost here, don't I? 120 more, but then my fixed costs are how much more over here? How much more are my fixed costs? My fixed costs came up 150, didn't they? I'm sitting here and taking out all of these fixed costs, my fixed manufacturing, right? So if I look at that difference, the 120 versus the 150, is that a $30,000 difference? That's a $30,000 difference. So that $30,000 difference is what? Is the fixed costs are a little bit more, my product costs a little bit more on my cost of goods sold, but I've taken all of the fixed manufacturing and expensed them for the whole period. So if you look at that difference, that's the $30,000 difference, right? Okay. All right. So let's go ahead and let's take a look at another question now and see if we can work our way through this one. A little bit better this time. Okay, let's see if I can make this a little bigger up here. Might have to move it around, but at least we can see it better. Okay, so we're sitting here. In this one, they gave us a selling price for this, and they're giving us all this information. And then they ask us what is, and I don't think I'm going to be able to highlight once I do that, what is the operating income for the month under what? Under variables. Okay, so when you look, they first figure out their product cost under variables, which is the, I don't know if you can see my pointer up there or Yeah, I guess you can. It's what? 22 for the direct materials, 43 for the direct labor, $3 for the variable manufacturing overhead. We don't pick up the what? Right, we don't pick up the variable selling administrative, and we don't pick up the fixed manufacturing overhead for variables, right? Right? Okay, so we get our total variable costs, and then when you just look at this variable costing income statement, it's simply what? The sales price times the 3,000 units sold. Okay, sales cost times the 3,000 units sold. You can see that right there. Sales price times the 3,000 units sold. Then I pick up the variable cost, which is what? $68 product cost, and 30,000 for the variable selling and administrative, which were up there, right? Got to get my variable costs. Okay, and that all gives me now what? This 30,000 gives me contribution margin of 144,000. Then what do? I pick up all of my fixed cost, right? I pick up all of my fixed manufacturing overhead, all of my fixed selling and administrative, and when I subtract all of that out, I get this 12,100 as my net income, don't I? Is my operating income, I should say. Right? Okay. Okay, good. Now, let's take this same thing and see if it'll let me write on it now. And let's do it now for absorption. Am I on the same slide? No? That the one we just did? Okay, so let's do this now for absorption. Okay. So do I have a sales number here? Same number, right? Sales is 378,000. Now I have to pick up my, let me write that a little better. Where's my other pen? Anybody see where I put my, when I was over there a minute ago, where I put that pen? I don't understand why that disappeared. I must have put it on, is there a sill or something over here? I had it when I started the class, and now I can't find it. Some days you should just stay home. Okay. So I have my sales. And now I have to pick up what? My cost of goods sold. And the way I'm going to pick up my cost of goods sold is by picking up all of my fixed costs here now. I mean, all of my costs, both fixed and variable. So do I pick up the 22? So I pick up that 22. Good. Do I pick up the 43? Good. Do I pick up the 3? Okay. Any others? I also have to pick up the what? Fixed manufacturing overhead, don't I? So when I pick up my fixed manufacturing overhead, I pick up my 89,900 and I divide it by what? Units produced, 3,100. Huh? $29, you say? Okay. So that's $29. Okay, good. Per unit. Okay, for my fix. And so when I add all those up, what do I get? 97? Okay, good. So I get $97 per unit. And for my cost of goods sold, I'm going to take the 97 times the units sold are what, 3,000? So when I multiply that out, I get what? 291,000? Okay, good. And that gives me my margin, whatever, gross margin, gross profit. I like to call it gross profit. They like to call it gross margin, whatever. But that gives me how much? 87,000. Okay. And then I'm going to take off my selling expenses, right? And the selling expenses are going to be fixed to 40, is it 42? Fixed is 42,000. And the what? The variable, that's the fixed. The variable selling is $10 times 3,000. So that's 30,000. So if I take off those two numbers, then I get what? 15,000 versus what? 12,100 was what we got for down here for variables. So 12,100 minus 15,000 is going to be 2,900. 2,900, and that 2,900 is what? Is the $29 per unit times what? Times the 100 units that we have extra sitting there in ending inventory where we've included the fixed cost, where under the variables we expensed it, right? We just took it as a period cost. Okay. Okay. That one went a little smoother. Let's take a look at this one now. And this one wants to know what is the operating income now using what? Using absorption. And so we pick up what? All of our variable costs. We know we got to get those. And then we have to get the what? Fixed manufacturing, which they pick up the fixed manufacturing cost, divide that by the number of units produced. That gives me my fixed manufacturing. That gives me this $88, right? Okay. Then what? Then I go ahead and I simply do my little calculation down here, which is to take the $112 sales price, the $88 per unit times the units sold, gives me my gross margin. Then I take off all of my selling and administrative expenses, both fixed and the variable, right? Right here. Okay, so I pick up that number. There's that 79,500. $6 per the number of units sold gives me the variable portion. I add those two together. That gives me my selling and administrative. That gives me my net operating income here, right? Do you want me to do it for variables? want to do it for variables? Yeah? Okay. All right, let's do it for variables then, because we're going to pick up what? We're going to pick up the 33, the 37, and the what? 5, so that gives me, 75? Okay, so that gives me $75 variable cost per unit. So not managing my space very well here. Sales, what else is new, right? Sales is 593,600. Okay, and my variable portion of my cost of goods sold here is going to be 75 times, how many units did they sell here? 5,300. So that gives me what? 397,500, you say? Okay. Okay, good. Then I'm going to take off my variable portion of my selling and administrative, and they tell me that's $6 times the units sold, which is 5,300, which gives me what? 31,800, you say? Okay, good. So when I take all that off, I'm going to take all my variable costs. I'm going to end up with my contribution margin, right? When I take all that off. So that gives me contribution margin of $164,300, you say? Okay, and then I'm going to go ahead and I'm going to take off what? My fixed cost, right? Everything? Right? Okay, so my fixed costs are going to be my 71,500, just looking up there, and my 79,500, right? And that gives me a difference of 13,300. Okay, so for variable, what am I doing? Variables here? For variables, I get 13,300, and for what? For absorption, I got 15,900. What's that difference? 9,600? 2,600? 2,600, which is going to be what? The fixed cost per unit, which is, what was my fixed cost per unit? Fixed manufacturing overhead per unit. We calculated already. 71,000, $13 per unit. Okay, the $13 per unit. There it is right there. $13 per unit times what? Times the 200 units that aren't sold yet, right? Because our inventory went up. Does that give us the 2,600? Okay. So the theme is the same now. This is the fourth time we've done this now, in which what? The only difference between the two methods, and we've said it now since the very beginning, is how we treat the fixed manufacturing overhead, right? For variables, you just treat it as a expense for the period. For what? For my absorption, is the way we were doing before. We leave those on the balance sheet in finished goods, and some of those costs could be in work in progress, but just for ease sake of, not driving ourselves insane here, let's just make sure that, let's just pretend it's all in what? In finished goods, right? Okay. Okay, good. So you come over Total period cost, thank God for a question like this. Total period cost under what? Variables is what? All of my fixed costs, right? Which is going to be my fixed manufacturing overhead, fixed manufacturing overhead, my fixed what? Selling and administrative, and my what? My variable selling and administrative, guys, is still considered a period cost under both, isn't it? So that's one of them tricky questions that could give you trouble on your test if you're not careful, and that you get all tied up in saying, well, I'm going to take that up there as part of my variable cost, and you start thinking of it as a product cost because it's up there. It's still a what? Period cost, even though it's up in the derivation. And what gets confusing sometimes is you're thinking gross profit, gross margin, and you're doing it trying to take away the cost of goods sold, which, and then we're going to take the selling and administrative after that, but we're trying to come up with the contribution margin format, so it's up there and helping us to come up with the contribution margin, right? Okay, so you want to kind of get this look as to how the financial statements look under the two methods, and a lot of these problems have done that. We've got the examples in the slides. Okay, now what they're doing here is what we already have done a number of times, which is just showing you that if you get your variable cost net operating income and your inventory levels have gone up by 5,000, you simply do what? Take the increase in inventory times that was our fixed cost per unit, fixed manufacturing cost per unit, gives you the what? Absorption. Or if we gave you the absorption, you could subtract the increase times the fixed manufacturing cost per unit to come up with the variables, right? By subtracting it. That's in a period when the inventory does what? Inventory increases, right? Okay, good. Now you come over and let's take a look at a couple of questions here. The principal difference between variable costing and absorption costing centers on what? Whether fixed cost should be included in product cost, right? Okay, under absorption, fixed manufacturing overhead are deferred in inventory. I'm not trying to strike that out. When production exceeds my sales, right? Because I'm leaving those things in inventory still. Okay. Now, come over and let's take a look at this one. George Corporation had no beginning inventory and manufactures a single product. If the number of units produced exceeds the number of units sold, the net operating income under absorption method for the year will be what? Greater than the operating income under variables, because we still have those costs sitting in our finished goods inventory, right? Okay, good. Come over and let's take a look at this question. And this question tells us that at the end of the company's first year of operation, 1,000 units of inventory remained on hand. Now, if it's our first year of operations and 1,000 units of inventory remain on hand, did we increase or decrease our inventory? We increased it by 1,000 units, right? Good. So we know we got to pick up that number, 1,000 units. And then they tell us that the variable manufacturing overhead cost is $45 per unit. The fixed manufacturing overhead is $10 per unit. And they want us to tell them if the absorption cost of net operating income, how much higher would it be than variables. And they're helping us out by telling us it's got to be higher. If I was thinking this would be a better question if they gave you higher or lower, right? So you got to know what to do with that change in inventory. But since the inventory did what? Came up, right? And it's what? $10 fixed cost per unit. Then that means that absorption will have what? A $10,000 higher net income? Or operating? I keep saying net income. Operating income? We're not calculating gains and losses on sale of equipment and interest revenue and expenses in this whole thing. It's on our operations, right? Okay? Okay, good. Come over. And let's take a look at year 2 now. Okay? And remember, they produce how many units every year? 25,000 units every year. And in year 2 now, they sold 30,000. So what are they going to do? They're going to sell everything they produced this year, plus they're going to grab those 5,000 units that were sitting in ending inventory at the end of last year, of year 1, and sell those too, aren't they? And so what's going to happen? That, well, we don't have that same number. What is it, 30,000 in this example? That $30,000 of cost sitting in finished goods is going to come off of the finished goods balance sheet and go into the income statement, isn't it? So what's going to happen? Now our operating income is going to come down by those additional 5,000 units we sold, right? When we compare variables to absorption. Okay, so again, you come over, same facts. We have our variable, we have our fixed. Variable per unit are fixed. Okay, let me catch myself up here. And you come over, and they remind us of our product costs, right, which we have the fixed manufacturing cost here under absorption. We don't have them under variables. You've seen that a number of times now. Then what? Then we come over and take a look at the next page, and what happens. We sit here and we have our variable costing statement now. 30,000 times the $10 variable cost per unit gives me my variable cost of goods sold. Then I take my variable administrative, which is 90,000. I take all of my fixed manufacturing overhead, and that gives me what? That gives me 260,000 of my operating income, right? When I go over to my buddy absorption now, I'm taking what? 30,000 times $16 per unit. And so now I'm going to what? Grab those costs that were sitting on the balance sheet, and I'm going to expense them, right? Those costs were already expensed. The fixed costs were expensed last period under absorption, right? I mean, under variables. We're taking them under absorption now. And so we go ahead and we see that we have 230,000. We have how much less income? 260 versus 230 is what? Is a $30,000 drop. 230 under absorption versus 260, right, under variables. So there's a $30,000 difference. That $30,000 difference is what? Those 5,000 units at our fixed cost per unit, which are now included in cost of goods sold, aren't they? Okay. Now, we can do a similar analysis like we did before, and that what? If you look at our cost of goods sold under variables, it's how much? 300 is our variable cost of goods sold. So 300 versus absorption, it's what? 480. So 480 minus the 300 means what? Means we've got 180,000 more cost of goods sold we're taking now, aren't we? But that is only offset by what? By a decrease in my fixed expenses of what? Of 50,000, isn't it? Right? And so what happens? That decrease of 50,000 means that I'm taking, I'm not 50,000, but what? 150,000. It's the whole 150,000 because I'm taking all of my fixed manufacturing costs down here, right, under variables. So it's only going to be offset down there by 150,000 more of fixed manufacturing costs. So that's a $30,000 difference. Is that the same number? Okay. So I'm taking what? I'm taking more cost of goods sold, not only because my units are more per unit, but I also have what? More units, and that more units offsets the what? The increase in my fixed expenses to a point where my variables is going to give me now a higher net income, right? Okay. So when my inventory levels do what? When they increase, I get a higher operating income under absorption. When my inventory levels decrease, I get a what? Higher operating income under absorption, right? What if they stay the same? What if I sell everything I produce for the period? My inventory levels stay the same. No difference between them because there are no fixed costs that got plopped on the balance sheet for the period. Everything rolled through to the income statement, didn't it? Okay? So you end up with this little, again, we've done this a number of times where we've reconciled variables to absorption. But I just want you to look at this nice little summary sheet that sits here. And once you kind of understand the details that we've admittedly kind of bludgeoned through here today, but once you get through those details and maybe you watch this thing again, even though it'll be a little clunky in some places, I think it'll kind of sink in a little bit for you when you watch it the second time. But then it comes down to just knowing this slide. If you know this slide, you could pretty much work all of those questions that we were looking at before. Of course, you'd have to know which ones to include and not include, cost to include and not include under the two methods. But notice that if our inventory levels stay the same, there is no difference between absorption and variables, right? If inventory levels do what? If they increase, then absorption is going to give me a higher net income than variables, isn't it? And if my inventory levels decrease, as those costs that are sitting on the balance sheet are released from the balance sheet into my cost of goods sold, then variables will give me the higher net income, right? Okay. Okay, good. So let's go ahead and let's take a look and see if we can handle this question. So variables, net operating income was $60,800, and they're going to want us to do what? Tell them what absorption should be. So variables is $60,800, and they tell me that inventory decreased. If inventory decreased, I know already that my answer's got to be less, doesn't it? Doesn't the correct answer have to be less? So look at this. I mean, it can't be the same. That number, it can't be the same. It can't be D because D is more, isn't it? And look, the difference isn't that dramatic. I mean, you can almost not even make a calculation and figure this one out, right? Okay, but let's just go ahead and let's take a look. It's what? It's the 200 units that we decreased, and then they gave me, and this was an easy problem because they only bothered me with what? The fixed manufacturing overhead number. They could have given me some other numbers in here, but I would have had to have known to ignore those because that's the only relevant number here, isn't it? And so I subtract that by 600, and that gives me the 60,200 answer. Okay. Okay, good. Let's try another one. Okay, and they tell me that inventory decreased, didn't it? And they're giving me the variables. They want absorption. I know the number's got to be less, right? So I take a quick look at those answers, and can A be the right answer? Can C be the right answer? Can't be the same because the inventory levels changed, didn't it? And I doubt very much that it's going to wipe out that much if we only have 400 units, right? But let's just go ahead and let's take a look at it. or whatever it is, 300 units, and it's 63,800, right? And we have to take the $4 times how many units? Times the 300 units. What's that, 1,200? We subtract that, right? We subtract that 1,200, that's 62.6. Okay? Okay, now, sort of a tough little thing, and if you mess up with your calculator, you're really in trouble on these, but sort of a tough little thing to go through and understand everything that goes on there. So my recommendation is that you watch this thing again, okay, and forgive the bumpy road in there in the middle, but watch this thing again, and you see why I was yelling at you to pay attention, right? Because it is, if you drift off, man, forget about it, right? And so if you need to, look at that again, understand the way that worked, but you're going to see that the mantra is what? You're going to, the two things you're going to have to know is which cost to pick up under the two methods, and then simply understand that what? The difference between, maybe you start with that, the difference between the two is what? Difference between the two is how we treat the fixed manufacturing overhead. That's it. That's the only difference between the two. And then you're going to have to know how to pick up the costs appropriately under variables versus absorption. And then they start getting into what? The comparisons. What do you get if you use one versus the other? And the comparison is really the easy part, which the difference is going to be the difference in operating income that comes from what? From those fixed costs per unit that we include in our cost of goods sold for our ending inventory for absorption, which we expense all of it under variables, right? And that one slide that I showed you that tells you how to handle it if inventory increases or decreases is going to help you answer all those questions, right? If you can master those steps, this is probably the more difficult part left to go on your final, and then we start getting back into more well, we're going to do some budgeting, but then we'll get back more into the analysis stage towards the back end of the class, sort of like that chapter where we did the contribution margin and all that. Okay? So hang in there. You're making good progress. What we'll do on Wednesday is we will pick up with chapter what? 7? Okay, so we'll pick up chapter 7 on Wednesday. Okay, guys? All right, have a good rest of the day. Yes, sir.
So just a reminder, Wednesday